Good morning. Welcome to Coffee with KPP Live, the show that's dedicated to providing you with advice for life so that you can live richly and work towards the life that you've earned. I'm Kyle Roy. I'm an investment advisor representative with Kentucky Planning Partners. And today what I want to talk about is the market volatility. We are in July of 2022 right now, and we have experienced the worst six-month start to the S&P 500 since 1970. It's the second worst start to a year since 1932. So we're in uncharted waters, so to speak. It's not necessarily unprecedented. We have been here before, but for many of us in our lifetime, it's the first time we've seen a market decline this deep and this fast ever. So I want to talk a little bit about how to invest in a market like we have now, but I want to give you some insight and some ideas to help you work through it, to help you bring calm to your investment portfolio, to help bring perspective on what's going on in the marketplace. And I want to give you just 3 points of advice and things to think about and perspective to give you more confidence and more hope as we work through this slump. And hopefully, if and when the markets rebound, you'll be able to realize that. As always, past performance is no prediction of future results in the marketplace. I do not, nor does anybody, have a crystal ball when it comes to investing. We have no idea what the future holds. However, there are some tried and true investment strategies that you can incorporate into your financial plan, or talk with your financial advisor about, or just you yourself think differently about your investments. And that's really what I want to do today to give you some calm. So the 3 things that I want to do is I want to compare your investments to your home, and we're going to talk about how you might think about your investments in a way that you might think about a Zillow investment or something like that. Second, I want to talk about what unit values are, share values, and how in this market, if you have a investment strategy where you're adding to your portfolio, how you're actually building that value, you're building that portfolio like you might build a house. So we're going to walk through that and how you can add to your portfolio even though it's down 15 to 30% perhaps, depending on how aggressive you are. And third, I want to give you an idea to look back in time and go back to a place where you're comfortable with your portfolio so that you can have some perspective of where you are now versus where you've been, and hopefully bring some calm to you there. So the first thing, I want you to think about your home. If you live in your home, are you looking at your home's value every single day on Zillow? Do you wake up in the morning and see whether or not the value of your home has gone up or down based on some algorithm that organization has? I'm going to venture a guess that you probably don't do that. But the reality of the situation is that your home's value is subject to market movements, just like your portfolio. A disadvantage to your retirement portfolio, however, is that the time that you can get the value of your portfolio is real time. Literally, within 5 seconds of what the last trade was on the market, you can see what your retirement portfolio or your investment account is worth. So it can be kind of an addiction, really, to look at that, especially when the markets were going up as fast as they were. People were looking up and seeing their statements and seeing how much money they were making day in and day out, and it seemed easy. But then when the markets pull back, that can become a terrifying experience to open up an app and see that your portfolio is down several $1,000s in one day or several percentages in one day. But again, if we bring it back and analogize it to your home, the value of your home fluctuates every day. If you were going to sell your house today at a certain amount, it doesn't mean you get that amount in a week or what you would have gotten a year ago. The market conditions and whoever's out there willing to buy your house is going to dictate the value. It's no different than your retirement portfolio. So I'd encourage you to keep an eye on your investments. Make sure that your investments are aligned with your long-term goals and perspectives. Just like you live in a house, you have a general idea. Is this a house that you want to raise your kids in? Is this a forever home perhaps? Or is it an investment property that you want to flip? Just like you have properties with different objectives, your investments should have different objectives as well. And especially for your long-term retirement assets, don't look at that portfolio balance every day, because I promise you, if you wait long enough, you're going to be able to make sure that that portfolio is aligned with your long-term objectives. And generally, again, I can't make any promises, of course, but generally, The markets will rebound. We are currently in the midst of the only bear market that has not been followed by a bull. In other words, there's never been a bear market not followed by a bull market, ever, until this one. And the only reason it hasn't happened yet is because the bull market hasn't occurred. So take a break from looking at your portfolio, because that's only going to cause anxiety. Okay. Second, especially in a 401k, if you're making systematic contributions into a 401k or an investment account, what you're doing is you're buying more shares of an individual stock or more units of an individual investment. And if I were to stick with the home analogy, what that does is that effectively allows you to build your home, but at a deep, deep discount. So even if the housing markets fell, and let's say the cost of lumber and the cost of home goods fell as well. If your house was worth $100,000 one year and it fell to $75,000 and you were able to build an addition on your home, even if Zillow said that your home was worth $80,000 after the addition, you still have more home. You have more home to enjoy. And in the event that the markets rebound, that addition that you were most likely able to purchase at a discount increases the value overall. So not only if you build an addition right after a housing bubble or your house's value goes down, you get to enjoy that addition. You own more of the house. There's more space to walk around. Just like with your investment portfolio, as you buy more shares, as you buy more units, it's like adding additions to your portfolio. That when the markets rebound, most likely those investments are going to grow with it. So even though your portfolio might be less today, you're still able to grow the foundation on which it will rebound in a bull market. The last analogy I want to do is I want you to look back in time. We all have cell phones. And I want you to go back and look through pictures in June of 2020 on your cell phone. First, you'll probably see things with your children, your grandchildren. You might have gone on a great trip. Now, it was at the beginning of COVID, so you probably weren't on a trip. But it probably was a time where you were spending more time with your family, and you'll find some things that really brought joy in your life at that time. And if we look back in the market, if we go back to June of 2020, February to March of 2020, the S&P realized a 30% decline. But from March to June, the S&P had regained everything it had lost and some. And since June of 2020, the S&P 500 is actually up since that point. So from June of 2020 to last year, we saw a great bull and we've given back gains. But I want you to ask yourself, as you look back on those pictures from June of 2020 on your cell phone, were you happy? When you were looking at your portfolio, were you happy with your portfolio balance was? Were you amazed at how much wealth your portfolio had created coming out of the downturn we had seen during COVID? The chances are you probably were. You were happy with what your portfolio value was then, and your portfolio value is worth more now, most likely, than it was then if you had maintained the course. If you look back 6-7 months ago to the peak of last year's market and you're comparing where you are today to then, that's just a snapshot in time. Some of you have heard me say that comparison is the thief of joy. You can take certain snapshots in time and compare where you are now to 6 months ago, or you can look back a little farther and realize that your trend line in your portfolio is most likely still up and to the right. And in investing, to maintain that up and to the right trajectory, it's important to maintain a long-term perspective. Realize that there are going to be ebbs and flow of the marketplace, but making sure that you have a financial plan, that your investments are aligned with your risk tolerance so that the volatility is in a range that you're comfortable with, and that when we look at times like now, that we're executing, and you with your financial professional is executing a strategy so that you're able to invest more of your dollars in assets that will increase the likelihood that you realize your long-term goals. So we'll repeat. So first, you're probably not looking at your home value on Zillow every single day. It'd probably drive you nuts. I like to look at Zillow values of other properties because I'm curious, but if you're looking at your home value every day, you will see fluctuations. Your portfolio value really isn't much different other than it's more transparent and it's going to be much more volatile than your home. If you don't look at Zillow every day, I'd encourage you to look at your investment portfolio every day. Second, if you're in a 401k or you have a contribution strategy, keep doing that because you're just building on those additions, so to speak, to your portfolio, and that's going to benefit you well if and when the markets turn around, which we at KPP are confident they ultimately will. We don't know when, but we are confident and we believe that they ultimately will. And this could be one of the greatest opportunities in terms of the market valuation to buy in as well. So keep adding to your portfolio, keep building those positions because you'll be grateful in the long term. And lastly, look back at a time, not in the too distant past, where your portfolio value was actually less than where it is today, and you were happy and you were thriving and you were impressed with your portfolio value and you knew that you were going to be okay. Granted, we're 2 years away from July of 2020, but if you look back at those pictures throughout your phone, you're going to find a time where you had smiles on your faces, joy in your heart, and your portfolio value was less than where it was. Don't let your happiness, don't let your well-being be dictated by short-term movements in the market, and recognize that you are moving in an up to the right trajectory. But again, it never hurts to have an audit of your portfolio. If this market is making you very nervous and you feel like that there's no end in sight, then what that means is that your allocation probably isn't aligned with your risk tolerance, and that means it's a great time to review your portfolio, have an audit of your portfolio, get a risk score done for you where you know exactly from a scale of 1 to 100 what kind of volatility you're comfortable with in your portfolio and what kind of experience you want. Because working with a financial advisor and building a financial plan is meant to bring calm and confidence even in times like this. So if you're looking for that, feel free to give us a call at KPP. Our phone number is 502-394-0400. We are located on the corner of Shelbyville Road and Hurstbourne Lane, right in the heart of Louisville's east side. We welcome the opportunity to talk to you. If you have any questions, concerns, please give us a call. My name again is Kyle Roy. I'm one of the many talented advisors here at LPL. Very humbly here at KPP, one of the many talented advisors, but we're already willing and able to help you, serve you, and work to the future that you've earned. So look forward to talking to you soon. Thank you for watching, and we look forward to seeing you soon. Bye-bye.